I think moving rates as high as they did was necessary to stop that pervasive idea that inflation was going to be sticky, because inflation can be a mindset shift. You know, we saw corporations after corporation just raise prices. And what this did was slow all of that down. So, no, I don't think it was a mistake. I don't think a Federal Reserve did a very bad job. Nobody likes going through a rate cycle like that. This is the largest of all of our lifetimes, and so therefore it's pretty ugly. It doesn't feel good. Nobody likes it. Business slows down for everybody, but it worked in terms of getting rid of inflation and any expectations of future inflation. So inflation expectations have collapsed in the US now.
The Federal Reserve's next likely move is another interest rate cut. And the big question is whether it will be a modest 25 basis points or a larger half percentage point reduction. Although the official announcement won't come until November 7th, discussions are already heating up over the size of the cut. The Federal Reserve's dual mandate is central to its decision-making process, focusing on managing inflation and fostering economic growth. Recent data shows core PCE inflation, the Fed's preferred measure, is now at 2.7%, close to its long-term target of 2%. This progress led to the Fed's first rate cut since 2020, a bold 50 basis points in September. This shift marks an important turning point after a period of painful inflation. With high rates making borrowing costly, the goal was to slow down spending. But with inflation easing, there's room to reconsider the path forward. Yet, not everyone is on board. Many individuals remain convinced that the financial system is on the brink of collapse, attributing this to excessive money printing and rising inflation. However, they overlook that the 8% currency debasement we are currently experiencing is a necessary cost to maintain systemic stability. Raoul Paul, CEO of Real Vision, highlights that this pessimistic perspective fails to capture the broader economic context. Concerns have been raised about recent interest rate cuts, particularly around inflation and the bond market. Paul dismisses these fears, pointing out that despite decades of scrutiny, the bond market has not collapsed. If required, the U.S. government can print money to stabilize the bond market, making a full-scale collapse highly unlikely. The rate cuts were essential in addressing overly restrictive economic conditions. With rates at 5.5% and inflation at 2.5%, the high cost of credit was stifling growth. Reducing rates allows businesses and consumers to refinance debt more favorably, stimulating economic activity. Paul argues that while previous rate hikes were necessary to curb inflation expectations, the Federal Reserve should now lower rates further, likely to around 2 to 2.5%, to better align with the economy's long-term growth objectives. Now let's take a look at the clips from the interview. Before we proceed, we invite you to like this video, subscribe to our channel, and activate the notification bell.
There's a large group of people who want their justice. They want the system to fall apart, to say, I told you so. You're printing money, you're creating inflation, you're doing this, it's all unsustainable. And they don't want to see that what's actually happening, this 8% debasement, is basically all of us being charged 8% for a put option on the system, which is actually maybe not that bad. And then a lot of people who aren't invested in technology can't stand the fact that it outperforms versus what was deemed to be the right way to invest, which was the value investor, the cyclical commodity, deep value, that thing. And that's not been working for 30 years. But yet they want it to come back. So they get more angry as markets go. And then they start drawing patterns about how it's going to crash. Well, markets, unlikely to crash unless it's further out the risk curve. But markets don't crash when the business cycle's picking up. They crash when the business cycle is slowing down. And let's say the ISM crosses 50. It never happens at this point of the cycle. So really, there's no real rational argument. And the Fed are cutting rates now. They're pushing liquidity into the system. The market's buoyant, and the ISM is going to start picking up. All the forward-looking indicators are. So it's really difficult to argue that there's a bubble and it's going to pop. And when we get to the bubble argument, something else they miss is they look at price earnings. But price and earnings, if you remember the story of your earnings and house prices are always going up more than your earnings. Well, what is price earnings? It's the share price, which is driven by debasement, and corporate earnings, which are driven by GDP growth. So over time, as we add liquidity into the system, the everything code suggests that price earnings will keep going higher because of this dynamic. But people don't understand it. So they look to a world of the past. Now, this has actually all been done before. This is not a brand new thing. After World War II, this is what they did. They used yield curve control as a way of stimulating the economy, and they essentially grew their way out of it by refinancing the debts. And we had exactly the same 4-year cycle back from about 1948 to about 1968. So we had 20 years of it back then. I think moving rates as high as they did was necessary to stop that pervasive idea that inflation was going to be sticky, because inflation can be a mindset shift. You know, we saw corporations after corporation just raise prices. And what this did was slow all of that down. So no, I don't think it was a mistake. I don't think a Federal Reserve did a very bad job. Nobody likes going through a rate cycle like that. This is the largest of all of our lifetimes. And so therefore it's pretty ugly. Doesn't feel good. Nobody likes it. Business slows down for everybody, but it worked in terms of getting rid of inflation and any expectations of future inflation. So inflation expectations have collapsed in the US now. In fact, where are they today? So 5-year break-evens are at 2% and 1 year are at 90 basis points. So nobody's expecting inflation because the Fed did a good job. Now they need to bring rates lower, and they have to bring it a lot lower. You know, I still think rates come down to 2.5, which is the trend rate of growth of the economy.
In recent months, the global economy has continued to rely heavily on liquidity as a central tool for maintaining growth and stability, a strategy that has defined economic policy since the 2008 financial crisis. Central banks, including the Federal Reserve, European Central Bank, and People's Bank of China, have been actively injecting liquidity into financial systems to prevent collapse and support markets, reinforcing their reliance on this approach. Since 2008, liquidity has been the driving force behind economic cycles. Governments worldwide, particularly in the US, EU, and China, implemented a global debt reset by pausing interest payments and relying on liquidity injections. This strategy debases currencies, easing debt servicing and inflating asset prices, which creates the illusion of rising value in assets like stocks, gold, and crypto, despite their real worth not increasing in equal measure. According to Raoul Paul, the liquidity-driven cycle has followed a predictable pattern. 2022, the global economy experienced a macro winter, characterized by high inflation and market declines. By 2023, recovery began with macro spring, revealing early growth, especially in the tech and crypto sectors. As we enter macro summer, broad market gains are emerging. Historically, this phase accelerates around U.S. election cycles, with markets typically gaining in the first half of the year, moving sideways, and then surging toward macro fall, expected to peak in 2025.
So, I've talked about this at length about the everything code and how the entire economic machine is now driven by one key thing, which is liquidity. And that's now driving the business cycle. Liquidity became the most important thing in the world after 2008, when we had a global debt reset, but not how people expected. We had it by them forgiving all interest payments for a number of years. So everybody reset their debts, didn't have to pay interest, and everybody reset their debts at a 3 to 5 year time horizon. That's all the major governments in the world, from China to Japan to the US, the UK to the EU to Canada, everybody. And since then, the world has been on this cycle. Every time you refinance the debts, they add liquidity in. Now, the use of liquidity to, i.e. debasement of currency, to pay for the interest payments on all the debt is the thing that causes assets to go up, because the debasement is actually lowering optically the value of fiat currency. So it's a bit of a mind trick, and people don't see it and don't understand it. But this is why markets go up. And then, over time, I've looked how cyclical this is, and that it repeats, and we can forecast it into the future by using certain forward-looking indicators as part of the everything code. And everybody's going, go to my YouTube channel, see that video. So Raoul Paul, the Journeyman, see the video, the Everything Code. It is 2.5 hours long, but it is the most important thing I've ever put out. And so what we get is, bizarrely, it breaks down pretty much by year, not perfect, but so 2022 was macro winter. We had inflation. We had recessionary conditions in all markets. It wasn't called a recession in the end, but regardless, everything went down and everything went to shit. Next year, spring. What happens in spring? You get shoots of recovery. What happened? Tech stocks, crypto, things in secular trends did really well. But the business cycle remained low. So the forward-looking things, the things that are driven by liquidity, which leads the business cycle by a significant period of time, had started to recover. Then you get into macro summer. Macro summer is when the economic machine starts firing up again. And that lends to another acceleration in markets and growth, whilst inflation tends to be falling or subdued. And that's a really lovely period because you can make money in pretty much everything. Commodities go up, gold goes up, small caps go up, crypto goes up, tech goes up, everything goes up. And that's where we are now. And so that summer period, the real footprint usually accelerates.
In the coming years, the recent interest rate cuts are expected to stimulate economic growth by allowing businesses and consumers to refinance debts more easily, fostering investment and spending. While inflation concerns persist, a bond market collapse remains unlikely due to government intervention capabilities. As the Federal Reserve potentially lowers rates further to around 2 to 2.5%, we can anticipate increased consumer confidence and hiring, contributing to a robust job market. Please share your thoughts on Raoul Paul's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.